I love it when a plan comes together. Some of you may recognize that quote from John Hannibal Smith of the A-Team. Well, it's one of my favorite ways to think about Richard Berger and his investing approach. Of all the people I've interviewed on the show, few have investing strategies that excite me more than Richard's. Today he's going to break it down for us and show us how it can help you ride out a bear market. Welcome to Invest in the Family Radio, a podcast about learning to invest. My name is Brian Bain and I'm your host. At Invest in the Family Radio, we believe that every dollar and minute we spend is an investment in something, and together we want to make the best investments that we can. So thank you so much for joining us. Remember, our goal here is to help you learn to invest financially and in all of life. You can always find more at investinthefamily.com and subscribe to the podcast at iTunes, Stitcher, or the Google Play Store. And as always, if you'd like detailed show notes from today's show, simply text the word family notes, one word, family notes, to the number 44222, or go to investinthefamily.com and sign up for our email list there, and we'll be sure to get you taken care of. Do you like shopping for insurance? Of course you don't. It can be a terrible experience, especially when it comes to life insurance. But if you have loved ones that you want to take care of financially after you're gone, then you may want to consider term life insurance, and Policy Genius is the easiest way to get insurance, period. At Policy Genius, you can figure out what you need, compare the top policies, get covered, and save. If you want to save on term life insurance, go to investinthefamily.com/policygenius. That's investinthefamily.com/policygenius for access created specifically for Investor in the Family listeners. I do get a small commission if you use my link, which costs you nothing. It's a win-win. Visit investinthefamily.com/policygenius for more info and have the most enjoyable insurance shopping experience you've ever had. And hope you enjoyed today's show with Richard Berger. Well, hey, Richard, welcome back to the show.
Thank you. Glad to be back. I enjoyed our previous talk.
Yeah, I had a great time, and I really appreciated the investing philosophy that you have and the way you shared that as far as how you use options and your price targets. And so I won't get into the details of it now because we don't have time, but I really have thought about that a lot and appreciate. Actually, I've referred to it frequently in different interviews as far as one of the better approaches I feel like I've heard. So I respect that and appreciate you sharing that before. And today specifically, you wrote an article a couple weeks ago. This is early October 2016 that we're recording this show. But you wrote an article titled The Coming Bear and How to Prepare. And first of all, great title, and also a subject that I'm very interested in. And so I'm glad to have you here today and discuss that a little bit more.
Yeah, it seems to be a subject we all think about.
Yeah, no doubt. Well, do you mind sharing with us just the brief thesis and premise of the article?
Well, yeah, the article was initiated as a response to a question basically phrased almost as the title is by one of my subscribers who wondered if I had any advice on how to, whether we should be moving money onto the sidelines and preparing for a bear market to come. And I initially just responded to him in private and then thought it was such a universal question, it'd be a good idea to expand and write a full article on. The essence of it is, and ties into my investing philosophy approach of finding high-quality stocks and investing in them at the right price and working with them to generate income, is using those tools. We're really in a position to ride out bear markets. You can really only find when you started a bear market, when you've reached a bottom, and when you've gotten back out, only in hindsight. There is no, even in the middle of it, you don't know whether you're still on the way down with a dead cat bounce or whether you bottomed and are really headed back up. And for those reasons, you leave a lot on the table and can really damage yourself by bailing out in the midst of a bear market. And the best thing to do is plan in advance so you don't need to bail out.
So talk to me about planning in advance. Like how are you doing that yourself, or how are you talking to your subscribers about doing that?
Well, part of that, again, is just the overall approach where I focus on investing based on value pricing so that I can focus on value rather than price. A major market-wide dip will, of course, takes everything down with it. But value hasn't changed in a lot of fundamental companies. Only the price has. So I don't let price disturb me when it's falling, even falling deeply, as long as I don't need the liquidity. Price becomes a factor if I have to liquidate during those down times. So I do One thing I do is keep a certain portion of my portfolio in my emergency money that if I'm going to need to depend on it, it's there and available liquid without having to liquidate any holdings that I bought at a higher price and are now suppressed. So that's one element, is having that emergency fund available. I used to keep that in cash or near cash. I have been experimenting for about going on 2 years now. I think I started writing about an idea using gold a couple of years ago, whereby I don't recommend the metal itself, and I don't recommend gold miners as individuals or even as mutual funds or ETFs, because there's too much volatility in the gold miners, and again, an overall systemic market crash is going to pull them down. Even if gold's soaring, it's going to keep them suppressed somewhat. But what I've done is I'm buying GLD, the ETF. Generally, I tried and did get in when the market was a little below the average all-in cost for miners, so that's sort of a natural floor. Gold may drop below that for periods of time, but in theory, miners stop mining at that point for the most part, and that sets up the next shortage to start driving prices back up.
And so approximately, do you remember approximately what gold was at that point? As far as
118 or something like that, I think. Right. 1180. So the GLD was at 118. So around 11 to 1200. I think last I looked a year ago was the all-in cost for gold miners globally. I then take the gold, which I want to liquidate. I only need it when we've had a systemic crash and everything's down, and I need liquid cash to fund my living expenses. And based on that, I sell gold covered options, just like I do on my income equities, at some near or a little above my purchase price, cost of gold. And I do them short-term, 1 or 2 month contracts at a time, sometimes out as far as 3 months. And my theory is I'm generating a regular monthly income of 1 to 2% a month, 12 to 24% annual based on the option premium. And at the same time, it will self-liquidate just when I need it. If the markets have a systemic crash, that's when gold surges, and it'll get called away from me and turn itself back into cash just when I need it as cash.
Yeah, so in that sense, you're not concerned with missing out on significant appreciation because
I'm not holding the gold to really try to make much money on gold. My goal is just to stay flat with gold. It's money I would otherwise be keeping in cash or near cash and earning virtually nothing on anyway. So this way it gives me a method of keeping a highly liquid asset but generating a decent return on it while it's waiting on the sidelines and I don't need it.
That is fascinating. Again,
so that's one preparation.
Yeah. Okay. Yeah. Let's keep going. That's fascinating.
Another preparation is the overall approach I take to my income portfolio, where we focus on value investing. We buy using cash covered puts below fair value strike prices, so we have an inherent portion of the downside market risk built in. We're not buying those stocks until they drop 5, 10, 15% below their market price and reach a price below fair value. So that, especially as we're in a market which obviously, for the most part, is closer to a high than a low, even if it keeps proceeding in the up direction a long time, that's still generally true.
And so here, this is where you're selling cash covered puts, but at strike prices 15 to 20% below current rates, because basically you're selling puts at prices that you'd want to buy the equities at.
Yeah, again, my as we talked in my earlier interview, my 3-pillar approach is identify high quality dividend income stocks with safe dividends, the dividend aristocrat type companies. then determine their fair value. And this can be by any of the traditional tools, or I've developed a few custom tools like what I call my YDP screener. And then once you know the fair value, and you then look at the market value, the market price, and you can tell whether the stock is overpriced, underpriced, or about at fair value. If it's overpriced, we write cash covered puts at a strike price below fair value. So we get paid to wait until the stock drops to the price that we're a willing buyer anyway. Once we own a stock, we write covered calls on it at a strike price both above our own entry price and above fair value, so that we only have it called away if it reaches a price high enough above fair value that we've already determined it's in a bubble and we want to sell at that price range anyway.
I love it.
So we are paid to do exactly what we're going to do anyway. And in that sense, the extra income is all the option premium money is all just kind of free income and gives us an insulation to part of market risk, because the cash covered puts are going to be always, leading on the downside of the market. They're going to require a significant market drop before we might end up owning stocks that we're waiting to buy.
And to be clear, the only two kinds of options you're working with, first of all, you're not buying, you're selling options, and you're selling cash covered puts, and you're selling covered calls, which means that in both cases, you have a backstop on those. So covered calls, you have a backstop because you already own the shares, so you don't have to worry about massive, significant losses there, or really any losses. And then on the cash secured puts, you are secured as well because you have the cash on hand and you want the company. So the quote unquote worst case scenario is they make you buy the company at the price you wanted anyway.
Correct. Exactly right.
I love that. That makes us so happy.
If we have a stock put to us, we're not going, oh my gosh, we got stuck with this stock as the price is dropping. We're going, oh, the stock finally got down to the price I want to buy it at.
And you got paid to wait.
And we got paid to wait all the time we waited. Usually more than we get paid in the dividend yield. Matter of fact, always more than by dividend premium yield, not dividend, option premium yield, more than we would get by dividend yield in holding the stock. So we get paid more while we're waiting than we would while we own the stock anyway.
That's awesome.
And then finally, when it's down in a good value range, we enter the stock, and then we get to write covered calls to boost that dividend income going back up. During a down market or bear market, because we're holding quality companies with reliable dividends, we can live off our dividend income with minor option boosting, since obviously the premiums are going to be suppressed in the down market, and weather out the market without having to liquidate. There's particularly 8 core holdings that I call my dividend zombies I've written about. Those are 8 U.S. traded stocks that are over 100 years old. For more than 100 years, they have paid continuous dividends without ever suspending them or decreasing them, but always paying steady or usually increasing dividends. They've weathered the Great Depression, world wars, global famines, changes in technology, literally from buggy whips to the moon, from fire and coal to the nuclear age. These are companies that are virtually unkillable, and you can have the confidence to, regardless of how the market turns and Buffett's are pricing, you can have the confidence to ride out almost anything with them.
So, like, what are examples of some of those companies, out of curiosity?
Coca-Cola, Colgate Palmolive, Procter Gamble, General Mills, PPG, SKW, Consolidated Edison, ED. There's a couple of more. I have Exxon Mobil's one. It's one I'm currently shying away from just because it is an oil, so it's got its own issues, even though it has managed to get through more than 100 years. We may be coming up to a change in that with the oil markets.
Well, but of course, then back to, you said you had the different ways you guys are approaching the bear, and you mentioned the emergency funds. You mentioned you're taking advantage of this opportunity to sell cash covered puts so you can be prepared to purchase companies at the prices you'd like them to be at, maybe 20% below current prices. What are some of the other things you guys are doing?
Those are the primary things. We are becoming more and more prejudiced towards the puts, writing the puts and demanding deeper and deeper value, so that if and when the market does drop, that first 10, 20% or more of the drop will be absorbed just in the fall of the market before it hits our lower strike prices. So we're insulated from that first portion of the drop. That's part of the thing that causes people to lose money when they say, well, I've got a lot of investors just in the past month that have gone to the sidelines, mostly cash.
Right.
Of course, the market actually hasn't gone down in the past month. It's advanced.
Right. That's the
they're
thing.
leaving that lost opportunity behind, plus the income that they forego by converting to cash. We have to remember, going to cash has costs.
Right.
There's a risk of cash, too. The lost opportunity, inflation, lost income. So if you miss, which most of us probably would, getting out of a market when it truly turns to a bear, because we can't know it's a true bear yet, by the first 20%. A really bad bear, the 2008 bear market was a 57% drop. If you don't get out for the first 20% anyway, now you're only exposed to 27% on the downside. Chances are you're not going to know when you've got the true bottom. You're going to have some dead cat bounces, as it did. You may get in and then jump back out as you discover that you got back in too early, 2 or 3 times, and lose another 5 to 10%. So now you're 25, 30% of the 57% that you've left on the table on the way down.
Right.
And the bottom of the market itself is usually very sharp, maybe 1 to 2 months of the bottom 8 to 10% of the market. Chances are, by the time you've been wounded getting down to that point, by then you're a little gun shy in getting back, and it's going to rebound 20, 25, 30% before you're finally willing to bite the bullet and get back in.
And at that point, you might not have left anyway.
Yeah, so you've left most, or maybe even more than the absolute magnitude of the bear you've left behind and lost out on just by trying to time the market.
So tell me this. So how come you guys aren't selling more covered calls right now?
Well, again, we sell covered calls on stocks we're holding, that we own and we want to hold, until they reach fair value, above fair value. A lot of the stock market, especially the conservative stuff we invest in, is above fair value now. Exactly. Therefore, they're getting called away from us, and as they get called away, and we look to either go back into those stocks. If we're going back into those, by definition, they got called away, so they're over fair value. So it's time to write a cash covered put. The strike price we pick for that put, normally we may be 5 to 10% below fair value in a somewhat neutral market, giving a little bias towards the bear side. Maybe we're 15, 20, 25% below fair value as our strike price currently, depending in part on what sort of premiums we can generate. And I use technical charting and momentum a little bit to help, decide, do I want a $35 or a $37 strike or something. If moving $1 or $2 puts me on what appears to be the proper side of a resistance or support level, I'll adjust to that. So it doesn't really matter if I'm wrong, but it hopefully minimizes my transaction costs by staying on the side that it's got to make that little extra move before it triggers a trade.
Right. So just I want to summarize this to make sure I'm getting it right and also help our audience as well. So the primary ways you're approaching the bear market is, first of all, your system already accommodates most of it, which is really cool. So you own solid dividend companies that you have confidence in and you like as companies as a whole, and you're getting the dividends, but you're regularly selling covered calls, which means you're selling call options on companies that you own. So basically you own enough stock to cover those call options if they get called to you. And so as the market gets higher and higher and either reaches fair value or gets overvalued, you end up, by default, your system starts selling off those comp companies as they get overvalued. And so you're generating more cash at that point. And as that's happening, you are then looking at, okay, well, now I'm going to want to buy these companies back when they come down. And most likely that would be in some kind of a bear market. And so you're selling cash covered puts on those, in many cases, probably the same companies at 20% and even lower from where they are right now, so that if a bear market comes through, you'll be able to buy those companies at a discount almost automatically, and you will not have had to miss the ride down. And in the meantime, as you're collecting more and more cash from those companies being sold, you are putting that, or you had put a lot of that into gold or GLD specifically back when it was around the all-in cost for gold miners. So you knew that was somewhat of a floor for gold. Does that sound about right? Am I missing anything?
Yeah, that summarizes it fairly well.
Man, well, that is another reason why I enjoyed our last interview so much, because it's just, I get excited anytime someone does have some kind of a plan for their investing, because so often many of us don't, unfortunately. But I love it when someone has a really clear plan, and especially when it's a plan that just makes so much sense. And obviously yours hinges heavily upon determining what the fair value for a stock is. And I know we talked about that some in the previous interview. Do you mind just briefly telling us how you go about determining fair value of a stock, so you know whether or not you want to sell puts or calls?
Yeah, first of all, there's, of course, many ways to determine fair value, and different people have their favorites. And to a certain extent, it doesn't matter which way you use one that you're confident in that works for yourself. Now, what I do, I try to throw away theory. I'm a real practical guy. I don't care whether it should work. I want to know it does work, or at least has worked consistently in the past up till now. And so I look for metrics, financial metrics that are correlated to the actual price moves in stock. For instance, of course, I've described and written extensively on my YDP method. That's yield equals dividend distributions divided by price. And that's the mathematical definition. Yield is the ratio of dividend to price. The long-term yield rate, rather than the instantaneous current yield rate, is what investors, the market as the ultimate crowdsource of buyers and sellers of a given stock, that is the price to dividend ratio they've, as a crowdsourced agreement, said is the fair yield ratio between price and dividend. And then, knowing that average long-term yield, I can then take current dividend, divide it by that long-term yield rate, and that tells me what the fair value is. That is the ratio price that stock investors have been willing to pay to capture that dividend stream, to own that dividend stream.
So you look at the average long-term yield. So basically what...
there's, for instance, you can go to a website called, is it Yield Chart? I think it's called yieldrate.com.
Yield Right, like RIGHT?
Yield rate, R-A-T-E, Y-I-E-L-D, rate, R-A-T-E.com, or it might be called yieldchart.com, but I think it's yield rate.
Okay.
And you can get a complete history for the entire company's history with a best line fit of the average yield rate, and also most recent 5 years, so you can kind of more recent weight it for relevancy.
And so then you take that number, and then you add in. Then you take the current dividend divided by the current price.
Well, you take the current dividend. You divide on an annual basis the current dividend, multiply it to get your annual dividend, and divide that by that historic long-term yield rate.
Gotcha.
And that will tell you what fair value is.
Awesome.
Yeah. Now, I also find, and I like to use a multiple approach. If you can find some metrics that you can use 3 or 4 different approaches that all agree in the same ballpark, all the better. It makes you more confident in your numbers. I find that frequently share price per unit of free cash flow, price to free cash flow, or in the case of REITs, maybe price to funds from operations, often are very reliable predictors and correlated very well to the actual behavior of the stock price. So if you follow the cash flow numbers and their changing ratio, you'll also predict the price levels that should be expected.
Okay, so you said that's price to free cash flow.
Price to free cash flow, or REITs tend to use FFO rather than FCF, funds from operation, are essentially free cash flow, and then you put back in elective capital expenses so that you only charge out necessary capital investment to maintain your properties, for instance, in a REIT.
Right.
But the capital invested in buying new buildings is flexible, how much you flow into that. So they crank those numbers back into the funds from operations.
Right.
And what I also like about both that, for one thing, another mention on the YDP, it's very immune to financial manipulation by the company. The company sets the dividend rate, and in fact, indeed, some companies do occasionally set dividends over high as a value trap to try to attract investors. But the company sets the dividend, the market as a crowd source sets the price they're willing to pay, and by definition, that ratio is the yield. So it's very hard for the company for a long period to manipulate it.
Wonderful. Well, Richard, this has been a gold mine of a conversation and an interview. Thanks to you, and I thank you for coming on the show today and sharing about your methodology and also how you're approaching the upcoming bear market. And it's been very valuable, and I appreciate it greatly.
Always good talking with you, Brian. Have a good day.
You too. Well, I hope you enjoyed the interview with Richard Berger. Remember, you can get full show notes with links into the details at investorinthefamily.com. And always, you can subscribe to the show at iTunes, Stitcher, or the Google Play Store. And if you want my detailed summary sheet highlights from today's show, simply text the word family notes to number 44222 or visit investorinthefamily.com and sign up, and we will make sure to get you taken care of. This is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.